Chaos doesn't destroy wealth, it redistributes it. Every economic collapse in history has made someone rich, not by accident, but by following a pattern older than modern finance itself. From the Black Death to the Great Depression, from 2008 to COVID, the same move repeats. Most people lose everything, a few gain everything. And the difference isn't luck, it's knowledge. Let me show you how this works, not with theory, not with speculation, but with history. Because the pattern has been tested in blood, in panics, in crashes, and every single time the outcome is the same. Start with the Black Death. Between 1347 and 1351, half of Europe died. Villages were abandoned, farms stood empty, entire economies collapsed. For most survivors, it was apocalyptic. But for those who understood value, it was opportunity. With half the population gone, labor became scarce and valuable. Land that once cost fortunes could be bought for almost nothing. Survivors with liquidity, silver, goods, or the ability to work, suddenly had leverage they'd never dreamed of. Families that were peasants before the plague became landowners after it. The survivors who bought when everyone else was dying became the merchant class of the next century. The pattern was simple. Crisis destroys demand for paper promises and inflates the value of real assets. When confidence collapses, those with liquidity and courage buy what the desperate are forced to sell. It's brutal, but it's been true for 700 years. Fast forward to the 1930s, the Great Depression crushed America. Between 1929 and 1933, stock markets lost nearly 90% of their value. Banks failed by the thousands. Unemployment reached 25%. Families lost homes, farms, businesses, everything. The scale of suffering was unimaginable, and yet fortunes were made. Joseph Kennedy, father of the future president, saw the 1929 crash coming and sold most of his holdings before the collapse. When panic hit and assets were being sold at fire sale prices, he bought. Real estate, stocks, businesses. He walked away from the Depression a multimillionaire while millions of Americans stood in breadlines. The Rockefellers did the same. J. Paul Getty famously said his formula for wealth was simple: buy when everyone else is selling. This wasn't insider trading, it wasn't illegal, it was pattern recognition. They understood something most people refuse to accept. Crisis is not the enemy of wealth, it's the transfer mechanism. Now jump to 2008. The subprime mortgage crisis brought the global financial system to its knees. Lehman Brothers collapsed. Bear Stearns vanished. Housing prices cratered. Millions of ordinary families lost their homes, their savings, their futures. It was the worst financial disaster since the Great Depression. And once again, a small group made billions. Investors like John Paulson bet against the housing market before it collapsed and walked away with $15 billion in profit. Others like Warren Buffett and Carl Icahn waited for the panic to peak, then bought. Stocks trading at historic lows, real estate selling for cents on the dollar, distressed assets everywhere. By 2010, while ordinary Americans were still recovering, these investors had doubled or tripled their wealth. The pattern repeated perfectly. Panic creates sellers. Sellers create opportunity. And those with liquidity and patience become the next generation of wealthy. Then came 2020. The pandemic triggered the fastest stock market crash in history. Within weeks, trillions of dollars in value evaporated. Entire industries shut down. Unemployment spiked overnight. Governments printed money at unprecedented levels to keep the system afloat. For most people, it was terrifying. For those who understood the pattern, it was textbook. Within months, stock markets rebounded to all-time highs. Real estate prices surged. Those who bought during the March 2020 crash, when fear was at its peak, saw 50, 100, even 200% returns within a year. Meanwhile, millions of ordinary workers were laid off, struggling to pay rent, watching prices climb beyond their reach. Why does this keep happening? Because the pattern is built into the structure of crisis itself. When panic hits, most people do the same thing. They sell. They pull money out of markets, out of assets, and into cash. Thinking safety means liquidity. But liquidity during a crisis is an illusion. Cash loses value to inflation. Governments print more to stabilize the system. And by the time confidence returns, prices have already recovered or surged past where they were. The few who profit are the ones who do the opposite. They hold cash before the crisis. They wait for panic to peak. And then they buy, aggressively. They don't need to predict the future. They just need to recognize the pattern. Fear drives prices down temporarily, but value always returns. Those who can stomach the fear and act during chaos are the ones who capture the wealth transfer. This isn't about morality, it's about mathematics. Every crisis shifts wealth from the unprepared to the prepared, from the panicked to the patient. And history shows this so clearly it's almost mechanical. The Black Death transferred land to survivors with liquidity. The Great Depression transferred assets to those who bought at the bottom. The 2008 crash did the same. COVID did the same. The pattern doesn't care about fairness, it just repeats. So, what does this mean for you? First, understand that the next crisis is not a question of if, but when. Economic cycles are inevitable. Booms are followed by busts, and every bust creates the same opportunity, if you're positioned for it. Second, liquidity is your weapon. In good times, everyone feels rich because asset prices are high. But wealth isn't what you own when everything is rising. Wealth is what you can deploy when everything is falling. Those who survive crises are those who kept cash, avoided excessive debt, and didn't chase bubbles at the top. Third, courage during chaos is the price of admission. It's easy to say you'll buy low and sell high. It's another thing entirely to act when the news is screaming disaster, when everyone around you is panicking, when it feels like the world is ending. But that feeling, that fear, is the signal. Because if it were easy, everyone would do it. And if everyone did it, the opportunity wouldn't exist. Fourth, assets matter more than currency. Every crisis in history has shown that real assets, property, productive businesses, scarce resources, hold value when paper promises fail. Cash can evaporate through inflation, stocks can crash. But land, tools, skills, and tangible wealth survive. The pattern favors those who understand that money is just a tool, not the goal. Finally, knowledge is the edge. The reason most people lose in every crisis is not bad luck. It's ignorance. They don't study history. They don't recognize patterns. They react emotionally instead of strategically. And by the time they realize what happened, the transfer is complete. The wealth has already moved. This pattern has been tested in plagues, depressions, crashes, and pandemics. It has worked for 7 centuries across continents, economies, and systems. It is not a guarantee. Nothing in life is. But it is the closest thing to a proven strategy that history offers. Chaos is coming. It always does. And when it arrives, there will be 2 groups. Those who lose everything because they didn't see it, and those who gain everything because they did. The pattern doesn't care which side you're on. But history shows, clearly and brutally, that only one side wins. The question is simple. Will you be ready when the next crisis hits? Or will you be one of the millions who look back and say, I should have known? Because history doesn't repeat, but when it comes to wealth and crisis, the pattern always rhymes. And if you don't see it now, it will crush you later.